What does a Chinese property developer have to do with your investment portfolio? Well, apparently a lot of people think there is a connection. We'll explore that and more on the fastest 4 minutes in finance. Hello, I'm John Shrewsbury, co-founder of Gen Wealth Financial Advisors. Scott Inman is away this week. That Chinese property developer, Evergrande, and the problems that they have with liquidity rattled the markets earlier this week. The big question is whether the company could be the first domino to fall in a manner similar to when Lehman Brothers failed 13 years ago this past week. We suspect that a lot of the angst is owed to the old adage, history doesn't repeat itself, but it sure does rhyme sometimes. Given the time of year and the size of Evergrande, there are a few similarities to the Lehman Brothers financial crisis of 2008. However, we don't think Evergrande is another Lehman Brothers for a number of reasons. The debt of Evergrande is not being held by the world's banks for the most part. You'll remember that Lehman Brothers stock was held by almost every financial institution on the world scene. That possibility still does exist, but if that does happen, it's likely that the Chinese Communist government would step in to rescue the company. And finally, Evergrande has tangible assets that can be sold off to settle their financial obligations. For all those reasons, we think this week's market turmoil is a lot more noise than substance. We do think, however, that the turn of events this week demonstrate that a lot of people are hypersensitive to the possibility of a market pullback. In fact, any potential catalyst is often magnified by those just waiting to pounce on the next downturn. We think that it's interesting to note that the average year on the S&P 500 historically has produced at least 5% pullbacks 3 times during the year. Again, on average, the markets have demonstrated an inter-year drop of around 14% per year. But in spite of that negative piece of data, annual returns on the S&P 500 have been positive in 31 of the last 41 years, according to the Standard & Poor's. So what does all that mean? It simply tells us that things are never as good or as bad as they might seem. That being said, what does a person planning to live the next 30 years in their retirement money need to do? Here are a few thoughts. Number 1, be sure to keep enough cash to cover your needs for the next year to 2 years. Having cash allows you to ride out any market pullback and does not force you to sell stock holdings at an inopportune time. By the way, raising cash when the market is at a relative high makes you look really smart to all your friends, but that's just a bonus. Build some more cushion by moving some of the profits that you have that you've likely created into a portfolio that's more conservative. You can buy yourself even more time if any upcoming downturn is extended. Now, I know a lot of folks think that because the market has gone up recently, it will continue to do so. And they're kind of hesitant to take money off the table when it comes to stocks. Just remember an old adage, pigs get killed and hogs get slaughtered. Use this as an opportunity to take some chips off the table and bank those gains. Clearly, we don't know when the next pullback is coming. Just as clearly, we know one is likely in our future. That being said, we will leave you with one more adage. As John F. Kennedy once said, the time to fix the roof is when the sun is shining. That's it for the fastest 4 minutes in finance. For Scott Inman, I'm John Shrewsbury. Have a great weekend.